I guess the question we had is just the criticism that people have made, which is that in a sense fundamental uncertainty proves too much, and that it becomes really inconsistent with any sort of systematic theory about the behavior of the economy. You just have to end up falling back on, well, it's all a convention. And I know this is a debate you've been protagonist in.
Well, I think it's. I mean, I think that view is nonsense, because what he has a theory of expectation formation. It would be if you just said anything can happen, anything can happen. Anything can happen, by the way, in neoclassical economics. Let me choose the preference function, or alter the production function.
Yes, or stipulate a shock of whatever.
Anything is possible.
Yes.
Okay. So if Keynes just said, the world is just volatile and nobody knows anything about it and anything is possible, he didn't believe anything was possible. He believed there were reasons why the economy had the trajectory it has and was likely to have a trajectory that it was going to have, and so on. So when Lucas and Sargent and all these other people say that it's, well, anything can happen if you do this, Keynes says, I have a behavioral theory. I cannot tell you this precise mathematical form of this theory because it's a psychological behavioral theory, and it depends on institutions and context and so on. But I have a theory of expectations and confidence formation, and I will tell you that the simplest way to think about this is that as the economy is moving through time, the expectations that people draw about what the future is likely to be like is drawn from extrapolation by the past. And then the next question is, there's confidence. How likely are people to become confident in the truth content of their expectations and take risk on them? And that also, we can mathematize it. I mean, basically, if we wanted to mathematize it, we could do that. In my forthcoming Keynes book, I show how that's true. But it's no more anything can happen than anything else. So we say, all right, here comes a financial market boom, and people are maybe remembering the last crisis. They're a little nervous. They don't want to take too many risks and whatever. And then all of a sudden, things are going well. And so the longer things are going well, the more confident people can be, that they're more optimistic and more. And then you push it on, late 29, in which you can't lose. You borrow money to invest in this stuff. That's Keynes's model. And it's consistent. His model is consistent with a relatively stable capitalism much of the time. Mm-hmm. Most of the time there isn't something like really exciting going on in the markets and so on. So, and that's fine. That'll fit in the model. It's things, things are pretty smooth. You think they're going to go pretty smooth. The teaser is, if they continue to go pretty smooth, things that look, and you become more confident in that, things that looked a little risky now don't look so risky. You got stock market, bond market. Maybe let's say the bond market's more reliable, stock market's a little riskier, but stock prices are going up by 3 or 4%, or by more than bond markets year after year after year. That doesn't look like such a risk to get the higher ones. People will sell the bonds, buy the stocks, move things. So it's not an anything can happen model. You should not hang around with people who say it's just chapter 12.